Hey folks, welcome to Quants. Today we will understand the roadmap, which is very essential for all the option traders who are getting started in option trading, because options are instruments which push a lot of people away in very few trades itself, because of their characteristics, because of the payoff structure which are created using options. So now what we will learn is we will understand you know a roadmap wherein what are the essential things what you should know bare minimum when you want to trade options. So starting with first things first, everybody should know what options are. Okay, so before we go ahead and just put a bet on call option, let's say I'm expecting the underlying to go up, I'll just buy a call option. I'm expecting the underlying to go down, I'll just buy a put option. So just having that understanding is not enough. Instead of that, we should logically understand what options are. So what are options? So options give option buyer right to buy or sell the underlying shares at a predetermined price on a predetermined future date. So in this case, if I have bought a call option, that means I am holder of that call option. I have a right to buy the shares of the selected instruments on a future day, which is expiry date. So put option, on the other hand, gives us right to sell the underlying shares on a future date at a specific price. That specific price is nothing but the strike price. And in options, everything happens on lot size basis. Either it is one lot or multiple of lot size. Now, here the scenario is they become risky instrument, because even let's say this premium, it moves up by 5 rupees. So your PNL would be 5 into 1650. If that premium goes down by 5 rupees, that would be minus 5 into 1650. So your payoffs will change very drastically. So now one case that we know, call option will go up is when the underlying will go up. But on the other hand, options are not sensitive only to the underlying price. There are other determinants as well which are affecting our option premium. First of them is implied volatility. So implied volatility and option premiums are positively correlated. So in market, whenever the implied volatility goes up, the call and put both the premiums go up. So let me take you to what if. So if you are getting started in options trading, something like what if analysis is what you should play around a lot with. Okay, come to what if analysis and just move these sliders and understand the impact of all the variables on your option premiums. Now, if you see, I have moved it up by 8%. So what I'm trying to do is I'm trying to ask the application that what will be the impact of 8% increment in the implied volatility. So it's showing that the call option will move up by around 1 rupee and the put option will also move up by around 1 rupee. If let's say if implied volatility goes down by 13%. Now, if you see, the call option went down and the put option also went down. By the way, this whatever the premium changes, if I click on MTM, so it will basically multiply it by the lot size. How much it is? 2700 roughly on both the sides. So imagine if you took a trade. Okay, so this is where the problem starts creating, wherein let's say at this scenario you expected some kind of an up move to happen in DLF. Okay, so let's say 365 is what you expected, which is a fair enough up move. Okay, so now the call option has went up, right? So if I just uncheck the MTM, now if you see, it has went up by 1.67 rupees, but imagine if the implied volatility crushes by 10%. Now, if you see, despite there is a decent move or a very small up move in the underlying, but if you see how much the premium has moved, barely anything, right? So this is where the thing starts going wrong. The problem is that we just focus on underlying always, but only focusing on underlying is not enough. We should also understand the impact of other variables on our option premium. So now, apart from that, we can move the T slider. Also, the time affects our option premium. Each and every passing day, some premium will be pulled out from the option premium because of time decay, right? So time decays the premium each and every passing day, and eventually what happens is the premium melts. So why it means? Because of the time value of money which is there in options. So first thing is understand what are options, how are premiums made up, the formulas for premiums, and also what are affecting the option premiums and how much. So can we do it manually? Yes, we can. We can go ahead and create a Black-Scholes formula wherever possible, and eventually we can achieve this. But doing it manually, it is very tricky and it is very difficult. And not doing it, if I don't do it, then I will never understand the impact of the variables on my option premiums, and eventually I will keep on losing money to the errors, so which should not happen. So that is the reason, first, before your first trades, at least come to an analytic, like what if analysis over here, and just see how how the changes are happening. Just absorb those changes, and eventually you will understand what trade should be taken when. Okay, so one of the simplest things is, if you are expecting bullishness, then call option buying is lucrative strategy. Then on the bearish side, put option buying is lucrative strategy. But also account for the impact of implied volatility, also account for the impact of the passage of time. Now coming to the other aspect, so this was more from the operational part. Now we will understand about few more things what we should know if we are getting started in options. So first thing is, start to understand the built ups. So in futures, what is getting built up? So for that, just navigate to built up script symbol. So over here, what it shows is, it shows on what instrument what built up has been made. Long built up, so price and open interest both are going up. Long unwinding, so there were longs which were there in the system, those are getting unwinded, so profit booking. Then we have short. So what is short? Short built up is nothing but pairs where the pairs are aggressive, the price is collapsing and the open interest is going up. Last thing is short covering, and here the up move is just because of temporary shorts which are getting covered. Okay, so long unwinding and short covering are more temporary in nature, whereas long and shorts are more permanent, or not even permanent, but they are more like a trend in the market. So now understand the built up, then check on what futures what built up is getting built up. And whenever we are actually going ahead and taking a trade to form a directional bias, at least use this screen which will tell us in the market, are the bulls aggressive or the bears are aggressive. Now coming to the other aspect, also understand the options open interest data. Now obviously this video is more about an overview, more like an roadmap, so not going very much into detail. So understand the options open interest too, wherein it will show us the consensus, what the consensus are thinking, what the majority of the participants in the market are thinking. So wherever you see huge call open interest strike, that is where the call writers are most dominant. And wherever you see highest put open interest strike, that is where the put writers are most dominant. So highest call will act like a resistance and the highest put will act like my support. So always observe these data points, wherein these are basically showing you that where the maximum stake of call writer is. So whenever these call writers are actually getting defeated, there is a very good chance of big move to get triggered in the underlying. So just track where the highest call and highest put is. Whenever those levels are getting broken, there might be a possible opportunity out there. So always observe the options open interest data as well. So three things to summarize it. First, learn what options are, then understand the impact of variables on your options. What is affecting your option premium and how much. That we will get from option chain what if analysis. Always understand the build-ups. So what the build-ups are happening in the market. So with this, we will have an edge of knowing the bias in the market, right? Of having the bias in the market. Then we have options open interest data to gauge the consensus levels. So specifically, how can you identify resistance and support? It's very easy, just locate the highest call and highest put. So three things: what are options, then how options are affected, futures built up, and options open interest. So yes folks, that was it from my side. See you all in the next video, and happy trading.